Hello, everyone, and welcome to this interruption of our season break between seasons 1 and 2. We came off of hiatus because, in case you missed it, we held a presidential election in November, and we thought it important to bring you insights of what might lie ahead during a Trump 2.0 administration from someone who played an integral role in the first term. Dr. Mark Calabria is back, and we talk through his thoughts on nearly every facet of what the next administration's approach might be with respect to everything housing and lending related. So, AOLs and alternative title products, we go there. The future of the GSEs, we cover extensively. Overcoming hazard insurance concerns in key states, yep. Capital gains and SALT potential tax changes, we did. We also covered what should a federal government do to help cure our housing supply crisis? And what's the proper role for the federal government to play with respect to housing affordability? We talk interest rates and the chairmanship of the Fed. We talk about the proposed new Secretary of the Treasury. We discuss the MBA's RESPA modernization proposal and potential updates to RESPA and TRID. We talked about Dr. Calabria's experience with the new head of the DOJ's antitrust division, Gail Slater, and where her areas of focus are likely to be. And we talked about what pages some state regulatory bodies might want to take from outgoing CFPB Director Chopra's playbook and which pages they might prefer to ignore. We also talk about the Congressional Review Act's look-back window for the 119th Congress and what recent actions or guidance might be targeted for review. Basically, we cover tons of topics related to the safety and soundness of our housing economy on the backdrop of a new, or rather returning, Trump administration. So thank you for joining us today as we look ahead to your future. Given all the developments of late, we couldn't just stay away when there was this much great information to bring to you. So please enjoy my conversation with someone whose experience and influence are guaranteed to shape your future, the thoughtful and pragmatic Dr. Mark Calabria. The presenting sponsor of the Keys to Real Estate podcast is RamQuest. RamQuest fosters a customer-first culture built around an unwavering commitment to provide solutions that don't just meet, but exceed expectations. RamQuest's newest title and settlement production solution, Horizon, delivers unparalleled efficiency, robust features, and scalability to ensure you have tools to boost productivity and elevate performance like never before. Horizon streamlines your operation with secure 24/7 access, automatic updates, and all the power that only the cloud can offer. Plus, Horizon offers a direct connection to the industry's most extensive network of service providers and partners. Experience Horizon for yourself when you visit ramquest.com. And now, please enjoy the show. Well, Mark Calabria, welcome back to Keys to Real Estate. We're so happy to have you join us again.
Mary, it's such a pleasure to be back.
Well, with the change in administrations, we've been hearing a lot about what might be a part of a second Trump administration. And we should remind our audience that you served in the first Trump administration. And just quickly, would you remind everyone about your role during those years?
Sure, absolutely. Be happy to. So in 2017 and 2018, I was the White House's chief economist to the vice president. Most of my time then was really spent on taxes and trade, manufacturing, financial services, and a little bit of housing as well. And then in 2019, I was nominated and confirmed to be the director of the Federal Housing Finance Agency, which of course regulates Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. Has obviously a pretty big role in the mortgage market and by implication the housing market, and was there until the middle of 2021, overlapped about 6 months with the Biden administration. And led the agency's efforts to respond to the pandemic, which, of course, is the topic of my recent book, as you know.
Yes, and I love your book. I love that it's behind you because you were confronted with a kind of a unique housing crisis, and you took a very different approach to staving off a full-on crisis during the pandemic. Your book talks a lot about that, and I enjoyed it very much. I really recommend it to anyone that's listening. Also, I should say that we talked about it from the stage at the National Settlement Services Summit. And we released that conversation as an episode of the Keys to Real Estate podcast. That was back in season 1, episode 5. So I will commend that to anyone who did not get to see it live or experience it on the podcast. The book is really incredible. And I enjoyed your unique approaches. So, first of all, given that you were part of the Trump first administration, should we be watching your LinkedIn page for any job change announcements, or do you have any news to share today?
Not today, and not
Okay.
necessarily. If I've called to serve, but I was fortunate to work with a lot of great people, and I'm excited to see some of my friends come back. And whether I go back or not, I'm excited to see the direction of it. And I know there will be a lot of people that I worked with that come back.
Yeah.
And, I would go as far as say, I really kind of felt like the 2019, for instance, pre-pandemic, you're never really going to have a perfect housing market, but boy, we were getting really close in terms of affordability, in terms of income growth. And, that we really started to see construction come back from the Great Recession. So I felt pre-pandemic, we hit a real sweet spot with the housing market. And I'm optimistic we can get back to some semblance of that.
I'm so excited to talk to you about that today because, especially with the futures of the GSEs, there have been a range of possibilities prescribed by different groups with different thoughts. And that, can include leaving them in receivership as they have been for a very long time, bringing them out of receivership and taking them fully private or making them fully public. And so, sort of a shorthand for some of these models has been described as repeal and replace, or reform and release. And so I'd love for you to talk us through some of your thoughts regarding the proposals and the pros and cons of each scenario.
So I think it's always important, and maybe this is my time as a congressional staffer speaking, always important to kind of separate out the boxes between what Congress could, should, may do, and then what the regulator could, may, should do, because they're not the same thing, of course. And my view when I became FHFA director it wasn't my job to second guess Congress. It was my job to carry out the directions that Congress had given me.
Mm-hmm.
So, with that in mind, getting Fannie and Freddie out of conservatorship, in my view, really wasn't reform. It was simply implementing the existing statute. It wasn't going to change the structure of the GSEs. And of course, I am somebody who believes Congress should come in and make a number of reforms. But at the end of the day, the release from conservatorship really is just a continuation of existing law. When we wrote the existing law, we based it on the FDIC model. And just as, over the last couple of years, we've seen banks fail like Silicon Valley Bank or Signature, First Republic. FDIC did not sit on these banks for years. Right. It resolved the situation. It moved forward. That's the model that current law is for Fannie and Freddie. Maybe it's a great parallel because, as you remember with Silicon Valley Bank, there was a lot of debate at the time whether we should raise the limit on uninsured deposits, whether we should insure more of the system. And it's actually kind of interesting to me in that, if you think about it, we have about a little more than $7 trillion out there in Fannie Freddie MBS. Well, we also have about $7 trillion out there in uninsured deposits. And, for instance, about $1 trillion of that's at Citibank alone, which is kind of stunning in a way. Mm-hmm. And so just as the question of should we be raising the deposit insurance limit, or uninsured deposits at Citibank truly at risk or not, these are all important public policy questions, but they're really separate. And you did not see the FDIC suddenly say, well, hold on, we can't fix Silicon Valley Bank or Signature. We can't do any of that until those questions are resolved. They didn't stop because they knew those were questions for Congress, not questions for FDIC. I think it's important that the FHFA move forward with releasing Fannie and Freddie conservatorship because that's what the existing law requires. Now, that it's not going to happen overnight, even in the best of cases. It'll take you 6-7 months to get staffing up. There are a number of things you need to put in place. So a number of things need to be carried out, some of which we can talk about. But the bottom line is it'll probably take 2 to 3 years, and that will be more than sufficient time that if Congress decides to create an explicit guarantee, or, I have often called for the regulator to have chartering authority where, we could have 5 or 6, 10 or 12 Fannie and Freddies, the more the merrier, right? Or at least, it gives us the ability that any one of them gets into trouble, we can replace it. And so there are a number of different options that Congress could and should consider. But it's just important to keep in mind all of those things are really fundamentally a separate conversation from the question about an exit out of conservatorship. Yeah. And I think those things get mixed and matched way too often.
They do. They do. And so if you were advising Congress on some things to be sure to keep in mind as they were if they were going to write some legislation to get it back post coming out of conservatorship back into a true private, what would you tell them would be 2 or 3 things that are of high importance?
So, something I've recommended regularly is to give the regulator charter authority. So, for instance, the control of the currency issues charters for national banks. So, granted, it's not an easy process, but we have hundreds of thousands of national banks. And so I think having a process where you can create new GSEs or shut down old GSEs and be less reliant on Congress for deciding, like even today, you have two charters, Fannie and Freddie. You can't transfer assets between them. You can't mix and match because, again, they're still subject to antitrust, but you only have those two charters. Two is kind of an arbitrary number here. How do we know that's the right number? And in fact, it may be the worst number because, again, they often pre-conservatorship competed head to head. So you may want to think about ways to allow chartering, but also think about ways to kind of reduce some of the competition that happens in an adverse manner. So pre-conservatorship, it wasn't unusual for really big lenders like Countrywide to pay low prices on G fees, guarantee fees, and then your small, credit unions, community institutions all paid a lot more. And part of this was Fannie and Freddie were just buying volume, and they bought it in a way that I think was very destructive. But it was this intense competition between the two of them. Again, I think it was one of the things that contributed to essentially making them fail. So having some uniformity in pricing and some restrictions on their ability to compete too aggressively against each other, although you want to have some competition, but you do want to eliminate their ability to essentially discriminate across lenders. I'm not suggesting we make them common carriers, but make them a little bit more where the level is even playing field between the two. There are questions. I mean, what do you do with the portfolios? And again, pre-conservatorship, there were a lot of game playing. You were being ungenerous. You would say they were essentially running hedge funds on their balance sheet. And there's not a really public policy purpose for that. I would also love for Congress to address, what really should be the scope. And so, for instance, Fannie and Freddie have been very aggressive purchasers of mortgages on investment properties. And we've certainly seen in a supply-constrained market that those property sales have competed very aggressively with potential homeowners. I don't know if it's still the case, but when I was there, you could have, as an individual, up to 12 mortgages with Fannie Mae. How many mortgages does any one person need, right? And so how much should these companies be facilitating essentially investors?
Investors, yeah.
And so, again, I'm not against investor sales.
No.
But again, how much should this be driven by Fannie and Freddie is an important question. I would love to see revisiting. I mean, this will never happen, but since we're wishing away,
we can dream.
We can dream. It really is kind of crazy to me that Fannie and Freddie can buy mortgages over $1 million. At what point are we really talking about middle class housing? Now, I recognize that in many places like California, housing is simply more expensive. And what I would do, which we already have a model, so for instance, USDA runs a rural housing service program.
Yes, they do.
And so under 502, for instance, the loan, it's not set by a loan limit, it's set by an income limit.
Right.
And so to me, having something like that for Fannie and Freddie, where we truly say, we're not going to make this about what the house price is, we're going to make this about what the family income is, so that we can truly make sure that this is a facility that serves the middle class, I think would be an improvement. And again, we know how that works in the 502 program. It's not a mystery. It works relatively well. You can still get housing in rural America, even with those constraints. And again, it allows you to get around the problem of housing cost price and really get to the income issue and do so in a way where you're not artificially driving up housing prices. So those are some of the things I would really look at. I'm not terribly optimistic that Congress will address those, and I'm not terribly optimistic that Congress will do anything on Fannie and Freddie.
Yeah.
But I think there are a number of things you could do. But that said, it's important. If you don't ask, you can't. You're never going to get there anyhow.
Right. Well, and speaking of that, housing policy was, in general, was a big topic during the campaign, the presidential campaign, and there's no doubt that we have a supply and demand problem. So I'd like to talk about a couple of aspects, if we could. In your mind, what role can or should the federal government take to foster an increase in housing supply and add to inventories?
Well, first of all, let's just 100% emphasize that this is the problem primarily. We have a housing supply problem, and unfortunately, most of the Washington response is to simply increase demand, which obviously makes things worse. So
yes,
we need, I guess, first of all, do no harm. So let's not add more fuel to the fire. But let's focus on what we can do to increase supply. Now, the difficulty, of course, is that so much of the supply decisions are really local government, state government decisions. So, I think the bully pulpit can be helpful. It's, I hope that if Scott Turner is confirmed as HUD Secretary, that he's out there talking about zoning reform, entitlement reform in terms of the local level. So, I think that's important. Because it helps raise awareness and it helps change the conversation at the local level. And, you can sort of name and shame a little bit there. So I think that that's helpful. Mm-hmm. Another aspect where we do have direct control is in federal lands. Now, this doesn't do anything for you out east, but there's been for decades a process in Nevada where you can convert federal lands around Las Vegas into housing. And I'd love to see that expanded to other places out west. Now, it's not going to make a difference east of Mississippi. But, people might be surprised. Half of California is owned by the federal government, 80% of Nevada, I think something like 50, 60% of Utah. So you think about markets like Denver. There's just an extremely large amount of federal and state-owned land within Metro Denver. Same thing with Salt Lake. Same thing with Portland. So you've got these markets where there's a big federal footprint. And of course, nobody's saying we're going to build condos in Death Valley. Maybe the best example of this is if you've been by the Presidio in San Francisco, that was federal land. Right. And now there's housing on it. Lower densities than I would like, but it's a beautiful location. And, we have other spots in parts of metro areas out west. And of course, we've got underutilized, a lot of post offices are underutilized that can be converted to housing and the footprint that's there. So there are things where the federal government either owns the land or the structure where I think we could convert. I do think we could make a pretty big difference with making a very small difference on the amount of land that's actually transferred.
I'm so grateful for that rational discussion of that, because the first place anybody goes to is a subdivision in Yellowstone. Nobody wants that. And so
think the Presidio. Think that's the example of kind of what we want to do. Or what I would do. I'm not speaking for anybody myself, but, I think there's some broad interest in how do we utilize some of that underdeveloped land that is predominantly in metro areas. Mm-hmm. Again, I don't know if you've got a condo project for Death Valley, I'd like to see how you're going to get it to pencil out. But I guess I shouldn't say no. But
never say never, Mark. You don't know.
But this is a rational conversation about within metro areas where people already live. And you see this in Las Vegas, where sure, some of it happens a little bit more on the fringe of Las Vegas, but it's not happening in the middle of the desert. It's not, we're not going to the Hoover Dam and building a condo bridge or anything.
Right.
Like that.
There won't be an Airbnb on the Hoover Dam.
There probably would be a demand for that.
It would be cool.
Think of the views. So I don't know. I'm going to reevaluate that part of it, Mary. You got me on something now. So all that said, there's been some analysis done. Senator Mike Lee of Utah has a bill out that's a little different from what Harry Reid did in Nevada, but there's enough similarities. And I believe that when they did an analysis in Congress on Senator Lee's bill, they calculated if you just took 1/1000th of federal land out west, you could build up to almost 3 million units. So, and again, that's close to where our shortages are. As I said, it's only really a solution out west. But if you take pressure off, so for instance, you really have seen this out-migration from California, not just to Arizona and Colorado, but to Texas.
Yeah.
And so to the extent that we can fix housing problems in California, takes pressure off of out-migration to other states. So it really is something where you can improve this writ large. Mm-hmm. Now, I also think there are things we need to do. I mean, we understand insurance costs in many places like California, Florida are a big deal. And now, I'm not for federalizing any of that, but I think there are reforms so we can do flood insurance program. There are changes we can do in law, whether it's surplus line solutions where you can get additional insurance. And of course, you do see very differences across state. Places like Florida are opening up and having new insurers come in, and places like California, it's a little tougher. So how do you encourage more entry? How do you deal with some of those issues of where we build and how we finance it? So those are all important issues. I'm optimistic that fundamentally these are fixable problems if you're willing to sharpen your pencil, maybe make some tough choices, but ultimately choices that will pay off.
Yeah, agreed. Well, and I want to talk to you some more about that hazard insurance situation coming up in some of those tighter markets, but I want to stay with this so I don't derail myself. I'm of a certain age and I will derail myself in a moment's notice accidentally. There's some concern in our industry about sort of the balance of new immigration policies and how that could affect supply. What are you watching for on that and what are your concerns?
I think those are very reasonable things to question. Now, my view is, and again, this is just my interpretation,
Fair enough.
that I think that where President Trump is coming from is targeting this at people who are here illegally who have committed crimes and are some sort of threat and haven't been deported or get cycled through the system. So by and large, to me, I think there's a recognition that how do you get a path for the dreamers? How do you get a path for legalization that are people here that are working and contributing? But then how do you deal with people who are problematic and who are here illegally? And so I don't think there's a broad brush. But it's certainly fair to say that's developing. I mean, we'll see how that policy gets carried out. We'll see whether it's more complicated. But I also think there is a certain commitment to also try to create opportunities for Americans. And we've certainly seen, particularly among younger men, a real decline in labor force participation. So how do we try to get men in their 20s and 30s, 40s and 50s even, who have fallen out of the labor market back into the labor market?
Yeah.
And to create those opportunities. And it's not solely an issue of immigration pushing them out, but there is a connection, and there's a wanting to do that in concert where you are creating opportunity. Obviously, the incoming president I believe he feels like he was elected on the strength of the economy. So I think he is going to be very thoughtful about not taking actions that would necessarily undermine the economy,
Yeah.
and making sure that things are done perhaps in a more targeted surgical manner, even if perhaps some of the rhetoric sounds a little more broad.
Yeah, yeah, that's fair. Well, and in affordability, staying with that subject a little bit, there's been, and on rhetoric, there's been some back and forth between President-elect Trump and Jerome Powell lately, and at this point, it appears to be sort of merely rhetorical. So we'll wait and see if anything comes of that. But one thing that candidate Trump mentioned was a need or a desire for the president to have a more of a voice in what the Fed funds rate should be, and so. I'm wondering, what do you think is the appropriate role for the chief executive to have with respect to the Federal Reserve, especially interest rates?
So, good question. I never interpreted Trump's comments as saying that he was going to set interest rates or call the Fed and say, "Oh, we need 25 basis points today." That's not how I interpreted it.
Mm-hmm.
And it's important to keep in mind that pretty much every president, to some degree, and we certainly know from the Nixon tapes how blunt he was with Arthur Burns when he came in.
Yes.
So every president has kind of weighed in with the Fed one way or another. I think Trump has been more public about it,
Mm-hmm.
but I certainly can assure you that we haven't had a president in recent history who hasn't brought the Fed over and occasionally found ways to express their views. And again, one reason that you have this degree of independence in the Fed is that, they decide and they weigh that, and sometimes they take that consideration, sometimes they don't. Again, I think it is important, at the end of the day, the president is the one who bears the pros and cons of how the economy goes.
Sure.
So given that the Fed has a lot of leeway there, and of course that's why the president gets to appoint some people to the Fed. So I don't think it's inappropriate for the president or anybody else, really. Mary can have you can have a podcast on what you think Jay Powell should do.
Sure.
There's nothing wrong with that, and Jay Powell may even listen to it.
Yeah.
And so I don't think it's inappropriate for a president to express that. The Fed themselves always have to weigh that and figure out what the right thing to do. We have an independent Fed, but there have always been limits on the independence. And if anything, I feel like the Fed has gone too much off in a direction where it's become very highly politicized in the other direction. So to some extent, I would rephrase what I think many of the conversations about is actually making the Fed more neutral and getting it a little bit out of the political system in a way that it's already become embedded.
Yeah, it does get bandied about. And sometimes it inserts itself and then gets bandied about. And
Well, again, this is not to be partisan, but I'll just make the observation that in 2016, when you had a Clinton on the presidential ticket, you had a majority of the Federal Reserve Board who were former Clinton White House staffers. That doesn't strike me as an independent Federal Reserve. And I'm not saying that they tried to throw the election one way or another,
Right.
But I do think we need to start asking questions about, are we having a Federal Reserve System stacked with insiders? That's not independence either. And so who gets on the board is an important question. Are they someone who's going to challenge the groupthink that characterizes the Fed from whatever perspective? I guess I put it, in a frustrating way, when I hear people in Washington talk about Federal Reserve independence, what it really sounds like they're saying is they think that the Federal Reserve should be independent from Republicans.
It can sound that way, can't it? Yeah.
And again, so I'm going
Yep.
to give people, give the benefit of the doubt and say, how do we strengthen and have a Federal Reserve that's independent of all partisan politics and
Yeah.
all sort of groupthink, and have a little bit more middle. So again, it's not meant to be partisan. It's really just to say, how do we make sure that there's a balance there that's lacking today?
Yeah, that's fair. Support for today's episode is provided by October Research. October Research provides national coverage of case law, news, regulatory updates, and competitive business strategies critical for sustaining an innovative and compliant real estate business operation. Our portfolio publications offer independent and unbiased information that helps you stay educated and informed on what matters most to your business. So visit octoberresearch.com to learn more about our portfolio of real estate publications, sign up for free email news, educational webinars, and premier industry events for thought leaders. Knowledge, the competitive advantage. Well, and about the interest rates. So reports came out late last week from the time we're recording, and I should timestamp this for the audience. We're recording this on December 9th, but some news came out last week that one more rate cut is expected in December. And then some analysts predict that sort of the cuts will maybe hold back a bit while the Fed waits to see what the tariff policy ends up being and whether or not the deficit will be addressed or to what degree. And so I'm really curious as to what are some key indicators that you think are important to monitor kind of during this time of transition and during the first 100 days?
Well, and again, what the Fed is trying to figure out is, are Trump policies, have we beaten the existing inflation? So that's for starters. Are we there yet? And I think the answer is no, we're close.
We're close.
We're
closer.
Closer, but we're not there yet.
Agreed.
And, these are some tough questions. I mean, there's a lot of debate, whether the September rate cut was the right thing to do or not, given that inflation looked like it was coming down and then it looked like it wasn't. So obviously, probably the most important characteristic of any central banker is humility. You've got to be wrong a lot of the time, and that would be true whether it was me or Jay Powell. So, you're going to have to think about, how do you readjust? How do you look for clues on which way the economy is going? So first and foremost is, are we out of the pandemic era inflation yet? Right. And are we on target? And I would say close, but not quite there. And then the question is, when you're there, have you truly kind of reached the plateau? So that's the first question. The second question is really an issue of, are the policies that are going to be put in place going to be inflationary or deflationary? And to some extent, there's going to be both. So for instance, if we see a considerable amount of deregulation, that tends to be increased productivity and it tends to be deflationary. There are tax changes. So in instance, one of the reasons that the Trump administration chose not to reappoint Yellen was because she saw tax reform in 2017 as inflationary, because she saw it as an increase in spending. Whereas the administration's plan was, we're going to make changes on the corporate side. Corporations are going to invest more. That increases productivity, and that will be deflationary. So there was just a difference in what's your model of the world. And of course, there's often a difference in what's the net effect, because almost anything you're going to do is going to have a degree to which it's deflationary, a degree it's deflationary, and what's the net effect. At this point, what is going to be the bigger effect? And so I think one of the unrecognized aspects of the first Trump term was there was a tremendous amount of deregulation. Probably not as much as you and I would have liked, but there was a lot compared to where we have historically been. And I don't think people recognize it because it was in so many different areas. It's hard to point to any one and say, wow, that changed everything. But there was a number that things that added up. I used to say when I did speeches in 2017 that I felt a core aspect of the administration's economic policy was that we wanted CEOs to spend less time with their lawyers and lobbyists and more time with their clients. And again, that's, you've only got so much bandwidth and time in the day, and how do you allow people to really focus on that? So I would say at this point, it's too early to tell. I am optimistic that we will continue to see a moderation of inflation, but we're not there yet. And you got to be cautious. And I think the Fed will be very data dependent. It's also a question of, are you seeing a moderating in the labor market? And I think that's what, Governor Chris Waller is the one who recently commented on, he expects to vote for a rate decrease next time around. And I interpreted his remarks. I was actually there in the room when he was making them. And my interpretation of it was he really sees a continued softening in the labor market. And that's what he's looking at. So the Fed is very much, for rightly or wrongly, driven by a labor market lens for much of this stuff.
So, I checked this morning and I think the average ticked down a little bit to 6.84 or something. But do you think that the labor market is the primary reason they're kind of retail is being so stubborn?
Yeah, I do think that. I do think this is primary labor market driven. Now, obviously there's different things going on in the mortgage market in addition to just a rate environment altogether. And I'm hopeful that you almost get sort of a virtuous cycle, because once mortgage rates start going down, it's important to keep in mind that part of that elevated spread is prepayment risk.
Mm-hmm.
And once rates start to go down, that prepayment risk will shrink. And so you'll actually start to see it building upon itself. I wouldn't be surprised if, kind of once we break 6 on the lower side, it really gets to 5 quite quickly. We're not going to get back to 3% mortgage rates. And in fact, I would go as far to say you really don't want the world to be a world with 3% mortgage rate, because that means bad stuff's happening, which is like a pandemic or a recession.
Right.
But, if we're back around 5.5 for mortgage rates, I think that's a really good environment. And I think that's maybe in 2 years, maybe we're really around that environment. And again, once it starts to feed upon itself and people's expectations change and that prepayment risk aspect goes away, then I think we're going to start to see some real momentum.
We're ready.
But it's a process.
It is. Yeah.
It's a process. And of course, as we just saw with Syria, I mean, there's a lot going around the world that increases that uncertainty. But on the positive, we've seen progress in other aspects like Israel and Hamas. And I think we're seeing some movement in Ukraine and Russia. And I think if we start to get some more certainty around the world, you'll start to see a moderation. So part of the interest rate environment is a risk premium.
Sure. Yeah. Well, and the speed at which change comes now, whether it's the speed at which a rate cut is already pre-priced in or absorbed so rapidly, or some of these global changes, just for someone of a certain age, the speed, the rate of change, not that change is happening, but just the rate can be a little disorienting.
It really can be. I mean, I'm hopeful, cross fingers, that we'll see some, rapid changes in a good direction.
Yeah.
But
for a change.
But we're in a very interconnected world, and
we are.
And things can happen quite quickly, and things could turn quite quickly, and markets are 24 hours and respond, quite quickly. So things, again, just the communications on the internet and the web. I mean, I don't really think that, say, Silicon Valley Bank was necessity a Twitter virtual run, but I think there were a lot of other factors involved. But certainly those concerns and about trouble about a bank can spread quite quickly as well, and that's true about any company.
Yeah.
So, those are things that can move. And the housing markets can, the best example of this is just look what happened to Boise over the course of the pandemic. Shot up, shot back down. And that's an extreme, but there are a lot of other markets that experience that similar inrush of work from home. And now you're seeing the push back. And I think the biggest thing for the real estate market is, are we going to start to see a big push for people going back into the office, much more than we've seen in the last couple of years? I live here in Washington, D.C., where it's still walk into the door in any federal agency and the hallways are still pretty empty. And so I think there's going to be a lot of pressure to see a reversal of that.
Yeah, I agree. And in our world too, I'm yes ending you, sorry. We also are aware of how much just even one hack or instance of malware and a breach for just one major player in any side could just cascade so quickly. So we sort of always are dancing on the head of that pin, right?
Yeah, and it does. It's one of the things that concern me. I mean, I'm old enough to joke that you just give me a mainframe in the basement. I don't know that obviously the benefits, I think the benefits of the transition to so much cloud computing, although I joke, I mean, I'm old enough, I'm sure you're not married, to remember when we all started with the terminals to do our email that went to the mainframe. And then
Right.
obviously we went to having all of our own computer. And now it's like we're going back to
Back.
the terminals and now everything's just in cloud instead of a mainframe. And there are pros and cons with that. And cloud technology, and I'm not a tech guy, but there are different risks,
Sure.
particularly in hacking and vulnerabilities on the IT security side, that are really big for the financial markets. This is important for Fannie and Freddie. It's
Mhm.
important for any large financial institution because so many of them, and even when I was running FHFA, we as an agency were transitioning to the cloud. And so, brings a lot of vulnerabilities, again, a lot of flexibilities too. So,
Yes.
so I'm not a Luddite,
No.
underwriting our mortgage on an abacus. And
That's right.
don't need to go there,
And it'll
but
be fine. And then somebody will break in and steal our abacus. And then what
there
will
you
we
go.
do?
There you go.
I wanted to ask you about the Secretary of the Treasury, who obviously has a huge role and influences many of the policies that impact the housing and lending markets. So, what should our sector understand about the president elect's nominee, Scott Bessent?
So I think what you should first understand, this is a market guy. I mean, he's got a good sense of the financial markets. I think you're going to see a measuredness and a cautiousness. But even more importantly, and it's one of the things I always liked about Secretary Mnuchin, there's often this kind of, I don't know, dispassion, but objectivity. You
Yeah.
often see policy driven by whatever the emotion of the day is, and people who tend to be good traders know how to take their emotion out of the conversation because
A
you
little
will
more
lose money.
pragmatic. Yeah.
Because you'll lose money if you don't.
Right. Yeah.
And so I really see him as somebody who kind of lower the temperature on things and be analytical, but communicate this to the marketplace in a way where people really understand what's going on. Of course, there's going to be a lot on his plate: taxes, tariffs, sanctions. I mean, just a ton of things that go on at Treasury. It's crazy how much of a scope of things they have.
Yeah.
So to me, I think GSE issues, mortgage finances will be a priority, but I don't think it'll be a top five. There's just too much on the plate, especially on the tax front. But I think that there's some interesting things. So, I don't know whether this will happen. One of the things I've been advocating that I've gotten some pretty good feedback on is kind of what I call a sales tax holiday, where we, for say 2 years, increase the cap on capital gains. As you recall, the capital gains for home sales was set in 1997. And of course, 500,000 sounded like a lot for a couple then, and some markets it is today. But as a way to entice people out of those 3% mortgages and bring some existing home sales, I've been shopping around a proposal that, for 2 years, we just take the cap off. And so, yeah, you're giving up your 3% mortgage, but you're also getting out of the capital gains. And also, if you have a second home that you've paid off and you've been thinking about a good time to sell, this is it. So, kind of how do we bring some of that existing inventory back? Because
Yeah.
again, new inventory is important, but it's even more important because we have a lot of existing inventory that's just been on the sidelines, either because people are in the mortgage or they don't want to pay the capital gains. So,
Mhm.
I've been shopping that around with pretty good response so
I would
far,
imagine so.
but who knows whether it'll happen. I mean, obviously, all of this stuff needs to be paid for. And as
Sure.
you know, the president mentioned things like no taxes on tips and no tax on Social Security. Of course, I should warn you: do not think you're going to be able to convert all of your income into tips. It's not going to work
Oh,
that way.
come on.
I know, I know. It's going to be some governors on this, so it's not
Yeah.
abused. So don't rearrange your life.
Okay.
So all that said, there's going to be a real constraint to pay for these things, and
Yeah.
so it really just depends on what the scoring is. But there's a real interest in how do you have some things that are housing related. I expect there to be an increase in the SALT cap. I don't state and local taxes. I don't
Hmm.
think the cap's going to go away, but I think there's because it just costs too much to completely get rid of the cap.
Hmm.
But I think that there will be an increase in it that will give people in New Jersey, New York, Connecticut, Illinois some relief for those in the middle class. And so, but again, I don't see the cap going away. I just see the cap being raised.
Raised. Yeah. Well, if I may, I'd like to zoom back out for a moment because we tiptoed over here and I steered us to somewhere else. So I wanted to come back. I'd like to explore sort of your thoughts on how an administration that is committed, obviously, to regulatory reform and is allergic to bureaucratic overreach, how it might function in tandem sort of exploring the new water's edge where administrative authorities, where does the administrative authorities' power end now that we're in a post-Chevron deference world? So I'd love
Oh,
to
sure.
know how you see the realities of being in a post-Chevron world as helping reshape and resize the scope of administrative agencies.
So it's worth saying that even when I was at the White House, there's a unit within the OMB, the Office on Management and Budget, called OIRA, which is the Office on Information and Regulatory Analysis. And when rules come over from agencies, it goes to the White House and it goes to this OMB office. And back and forth between the agency, and so the importance here is there was already a change starting in 2018 that kind of fully blossomed by 2020, where OMB's approach was if you sent a rule over, it couldn't be just whatever goes. It has to be what is the best fair reading of the statute. And so, in a sense, you had already seen a transition pre Supreme Court case where, in my view, the Trump administration was trying to operate in a post Chevron world. Because where Chevron hits the road is largely in a Chevron world, if the agency can say that this is a reasonable, like if this is a, plausible read of the statute, then it's fine. Whereas you were really seeing a push again in the first Trump administration to say, is this the actual best read? Is this what the statute, is this what a layman would read the statute to say? So you were already seeing that. And I think that's a positive. Again, I'm a former congressional staffer. I don't, Congress spends a lot of time, a lot of thought. And I think it's a problem when agencies look at this and say, well, we know it says this, but we think we can twist the words to say this. That's not, I mean, that's fundamentally counter to our system of government, in my view. So you've already seen a way where the Trump administration already moved there. So I would say, and again, it's also worth remembering Russ Vought has been announced as going to be OMB director, and he was the last OMB director, and he oversaw this. So bottom line, I think you're already seeing the Trump team think the post-Chevron world because they were thinking that way on the way out last time. And this is a question of they can set up these procedures at OMB. Does it stick in 4 years? Does this become the new norm? Of course, a lot of this is going to matter in terms of courts. Obviously, Chevron really was more a theory of how the courts interpret it rather than how the White House interprets it. But I don't see it as a bad thing. I mean, does this force maybe Congress to do its job a little bit more? Sure, that's not a bad thing. And certainly as a regulator, I never felt I once needed to rely on sort of Chevron deference to do my job.
Good. Good. All right. So from that zoom out, now I'm going to zoom way in if it's okay. Going to get a little granular, but it's something that's really important to our audience. And it is the topic of the use of attorney opinion letters or other title insurance alternative products that have been bandied about and discussed in pilot programs and all of that. So some say that it's just sort of a tech-based and natural evolution that's the sort that's healthy in any marketplace. And some others fear that systemic risk will be baked into the system so obscurely that it won't be noticed until there's another calamity. Then all of a sudden, we've got a larger problem than anyone realized was being contributed to along the way. So I just wanted to kind of take your updated temperature on that. Do you have any concern about the safety and soundness of the system with AOLs, or is
it started as a process, process issue? And I think that, as you recall, the President Biden mentioned this in the State of the Union. So
he did
really kind of put it on the radar screen. Inauguration day, there'll be a change in leadership at FHFA. And the acting team will come in and I think, quite frankly, be skeptical at everything that was done. And you will see, just as when you, doing a recording, press pause, all these things will receive some degree of pause. At a minimum, they won't be allowed to expand. Maybe they're allowed, maybe I imagine for a number of things, the administration will announce that, for the next 30 days, we'll take delivery of loans made under these conditions. Because, of course, it takes 30 to 90 days sometimes to deliver. So there may be some grace period for lenders who've already used some of these items. But more or less, after X date, we're not taking delivery under these terms while we evaluate all of these programs and things like the Freddie Second Lien programming, all of these things where, there was a fairly aggressive read by the outgoing administration. But I do want to emphasize, pause does not mean necessarily go away.
Right.
It simply means that the incoming administration will take 6 to 9 months to review a number of issues. Some may therefore continue, some may be expanded, some may go away. And so I certainly expect the attorney letter of opinion to be pressed pause with at most an allowance of delivering some amount of loans that have already been done in the pipeline, but not originate new, and to see a review of the program both for safety and soundness. Certainly an open question of whether should it be put out for a comment as a new program. I know there was a sort of an RFI, but that's not the same thing as a new product.
Right. Mm-hmm.
So how do you make sure that even if this does go forward, how do stakeholders have a legitimate way to comment? And I think there'll be part of it. Ultimately, I do think there'll be a question of, my view for pilots was it's up or out. Like I believe there's only really one big lender who's using this now. And I was kind of the view that, Fannie and Freddie over time on pilots would do something with 2 or 3 lenders and keep it for like 10 years. And that to me, you either open it to everybody, you shut it down. Mm-hmm. And I think there will be a point probably in about a year where there'll be a conversation about, can some version of this survive or does it go away? And I don't think it'll continue in the route it's in. I do want to say is a bigger issue, and I think this is so important for many of the safeguards in the system, like title, like appraisals, like home inspections. The outgoing administration really had this view, reinforced often by Fannie and Freddie themselves, that so many of these things were just frictions. Oh my God, we need to get rid of this because originators don't like it. And how do we, make it easier? One big thematic change is that, as a reminder, FHFA is first and foremost a safety and soundness regulator, like the OCC, like the Fed. Its job is to protect the financial system. It may come as a surprise. Nowhere in law does it suggest that FHFA's job is to increase homeownership rates. Right. That's not there. Right. That's a made-up thing. So to some extent, the current administration, in my opinion, kind of making FHFA into HUD Junior, that's kind of reverse. You're really going to see it go back to be a safety and soundness regulator and focus on how do you protect Fannie and Freddie, how do you protect financial stability. And so while I don't want to prejudge any one particular policy, I think you will see a shift in attitude where there's less hostility to safeguards in the system and less desire to erode safeguards in the name of access.
Well, and you touched on so many of the key issues that I think some proponents of keeping at least the title insurance model, the predominant model, have been concerned about. First of all, they try to explain the Chesterton's fence theory of all that, of can we please understand why it's here before we knock it down? And those safeguards, and it just sounds, I think they run the risk of sounding like, well, let me talk to you about the 1870s and try to make it relevant today. But it's not. It's a point on the evolution, right?
And some of it is like, what's your job? Like, I worked for 2 senators. I worked for Phil Gramm and I worked for Richard Shelby. And the relevancy here is the coincidence of Shelby from Alabama was a state with some of the lowest title costs in the country. And Gramm was from Texas, one of the states with the highest title costs in the country. And we don't need to go in necessarily why title costs differ so much by state. But needless to say, I think there are some who view that the role of Fannie and Freddie is to come in and second guess state legislators. And that was not my view. And so to the extent that someone thinks that Texas, for instance, is not aggressive enough with insurers, that's a question for Texas. That's not a question for Washington. And so, again, to me, Washington is not the fix-all for everything. If you have a problem, if anybody has an issue with how the state capitals and the state governments handle an issue, that's for them to figure out and not us. And of course, as a broader issue, as we've talked about, Fannie and Freddie are in conservatorship, which is essentially an administrative bankruptcy. And I know this maybe sounds a little old-fashioned, but I really don't think we should turn to bankrupt companies as the leading edge of innovation. Their primary job is to fix them and get them to be no longer bankrupt and out, rather than think to be innovators. And of course, the primary role of Fannie and Freddie, even outside of conservatorship, is to be a counterweight to the market, to a source of stability. So again, I'm not someone who's terribly sympathetic to thinking that Fannie and Freddie need to be the driver of innovation everywhere. The rest of the mortgage market should be the driver of innovation. And again, it's not the role of Fannie and Freddie to fix perceived problems in state government.
Yeah, those are good points. Well, and I could talk with you all day and want to on that topic, but I'm going to move on because I know that we're trying to be respectful of each other's time here. But so much more to talk about on that, including that maybe at least a good pilot program length duration would at least incorporate most of the time frames that it takes for a claim to come through on a title policy.
It would be, and this is the tough thing. I mean, you want to have a reasonable, and we were trying to do this when I was there, and again, we never quite got across the finish line, but you want to think about, okay, the point of a pilot program is to both learn from experience how the program works and to gather data on performance. So you want a reasonable enough time to gather performance. Now, as we know, historically, loans have the biggest problems in the first 2 years. I'm not quite saying that if you get past year two, you're fine in terms of delinquency, but most of your delinquencies are in the first 2 years. So you want to have a good enough window where you've originated these loans, you've had, say, 2 years to see how they perform. And even for title defects, those may show up a little more along the life of the loan, but still many of them show up early on. And so you want to just figure out how's this handled. And to me, I always wanted to make sure we had an evaluation process. So a good example of this was when we were doing appraisal waivers in COVID. We had created a process to go back and look at the performance of those. And unfortunately, when I left, that largely went away. And I think this is an unfortunate, maybe perhaps philosophical point. I'm comfortable thinking that my actions and proposals should be subject to evaluation because I want to know whether they work. I don't think that was I don't think that's the philosophy of the outgoing administration. I think they believe their proposals are the right ones and they don't need to be evaluated. So I hope we have a bit of a more institutionalized process where whatever Fannie and Freddie do in terms of flexibilities and pilots, that there's a real evaluation. Hopefully, even that some of that evaluation can be made public and shared. Here's the performance of these aspects. And that way we can have a broader public debate on, what should things look like forward. This is one reason, for instance, why, I started a request for input aspect on collateral valuation. Is not that I don't know what the future looks like, but I think that when we decide these things, there should be an open and transparent process where all stakeholders get an input. Doesn't mean you win, but it does mean you get a say. It means your view is heard. And so I do think that you're going to see a more transparent process on many of these things going forward.
Great. All right. Well, lastly, we're in the lightning round. And I did poll some of our most robust audience members, engaged audience members, some of whom you know, to see what they thought we should ask you. And so the first one of our audience asked for your thoughts, or if you're aware of MBA's extensive suggestion for RESPA modernization that they've sent over to the CFPB in honor of RESPA's 50th birthday. I'm wondering, are you up on those? And do you have thoughts?
I haven't looked through them, but as a point of history, I ran the RESPA office at HUD when Mel Martinez was secretary some 20 years ago. Yeah. Still trying to block all that out of my mind. Yeah. But, I do think RESPA as well as TILA and the integrated disclosure should be revisited. It's a timely topic and not simply because of, people who have complained about closing costs, but because are consumers getting the information they need? Are they getting it on a timely basis? Is it placing undue burdens? And of course, we've seen since 2008, the cost to close a loan has, almost quadrupled. So are there things we can do to streamline the process that are still protective of consumers? So I'm a believer, without endorsing anyone's set of proposals, that I do believe it's time to revisit RESPA.
Fair enough. We have an audience member who wanted to know your thoughts on the person President-elect Trump has named to head the DOJ's antitrust division, Gail Slater, if you have experience or opinions there.
I worked with Gail at the White House when she was our tech person on the National Economic Council. I'm a huge fan of her personally. She was always very patient with me as a non-tech guy and was willing to explain stuff to me. And while I'm sure I'll have some policy disagreements with her, she's a friend, and I think extremely highly of her.
Awesome. Do you have any idea of whether or not they'll be focusing on the real estate sector over there, DOJ's antitrust?
I think when Gail was at the White House, she was the NEC's tech person. So she's a lawyer, of course. And so I do think this is a signal that a lot of her focus is going to be on tech. So I don't want to prejudge and say that my realtor friends are now in the clear, but I think there will be a shift away from the real estate industry, probably toward tech, but that's highly speculative at this point. Again, I do think that most of her focus is going to be on tech oriented. Of course, a number of real estate firms like to present themselves as tech firms. So be careful what you ask for.
Be careful. Yeah. All right, I've got one final question, but I'll do it in two parts, if it's okay. So we've heard that the current CFPB director, Chopra, might be leaving behind some thoughts or outlines for state regulators to consider during the tenure of a Trump-appointed CFPB director. And if that's true, do you have thoughts about what states might want to explore for regulating at their levels, or what they might want to ignore?
I mean, that's a great question. I mean, obviously, there's always some thoughts, and to me, Dodd-Frank kind of took this convoluted where CFPB creates a floor and encourages often states to go beyond. And so, to me, you don't get the values of uniformity.
Right.
And so, I would hope that a new CFPB director would ask in certain areas whether CFPB's authority is preemptory, and so that you could get, if you're going to have a national standard, should it be preemptory? And it can certainly be weak or strong, but also could it be clear? I don't think we benefit in some of these areas from having both CFPB and a 50 state approach. Again, there are a number of things like title insurance where perhaps it's fine that rates are set at the state level. So again, you want to work, and certainly CFPB needs to have a working relationship with the state AGs and enforcers, but I think it needs to be one where you're not making this overly complicated. And I would also say, I mean, CFPB is not going to stop going after bad actors. I mean, the real difference to me in how the approach is going to be, because, the reality is there are plenty of bad actors in the financial services space.
Of course.
The difference is going to be you're going to see less social engineering. You're going to see less attempt to use regulation to redistribute income among favored constituencies. And you're going to see more focus on how do you go after bad actors.
Fair enough. So the flip side of that two-part question, I'm wondering which Biden administrative policies or rules or guidance would you encourage the next Congress, the 119th Congress, to review closely during the Congressional Review Act's look-back time window? So basically, roughly anything that's been issued since August 1st of this year.
Well, on one hand, I had the privilege in 2017 being part of the team that did, I think we did 13 of those. So very large number across the board. They weren't, only a small number were even financial services related. I would expect a dozen or so CRA reviews in the first 6 months. And so I think there would be a pretty aggressive, and this is going to cut across agencies. I don't know that I necessarily see anything CFPB, FHFA related per se.
Okay.
There were certainly some outstanding things. And I'm fairly certain that the teams are looking at that and preparing those lists so that they can hit the ground running. And of course, as you have to understand as well, remember, the CRAs originate with Congress. So but the fact that Republicans hold both houses, and they're going to look at things where they know they can get it passed. So you got close numbers in the House. It's got to be something that's enough of a consensus. And if you can get it past the House, I think you can get it past the Senate.
All right. Well, Mark, thank you so much for coming back today and updating us on where things stand. We know you're always busy, and we'll be watching as you continue to influence the policies that shape our housing market. And we always appreciate your perspectives. We gain so much from your vast experience, and we hope you'll check in with us again as time moves forward and eras continue to change. But until then, just really thank you for all you do on behalf of healthy and sustainable markets. And thanks for helping us hold our keys to real estate. We appreciate you.
Absolutely. Such a pleasure. Till next time, Mary. Be well.
Thank you. Well, thank you again, Dr. Calabria, for shedding light on the things most important for a healthy and productive path forward for our housing market. We'll all be watching as you work to help make some good ideas a reality in our workplace. Now, audience, we'll be back in your feed soon, kicking off our second season. We'll bring you even more timely and important conversations of those working hard each day to help you continue to hold your keys to real estate. And if you have some staff in your office who know how to do the work, but could use some help in understanding what it all means, have them subscribe. Let us help train them up on how what they do contributes to the overall economy, and how what we all do matters so much. Until next time, I'm Chief Knowledge Officer Mary Schuster. Thank you for believing, like we do at October Research, that knowledge really is the competitive advantage.